Guys, in this channel, I always preach data analytics. I always say that you as a regular person has all the same data as Wall Street right in front of yourself, at your fingertips. 10 years ago, only the major banks, only the major corporations, only the analysts, only the hedge fund managers, those, financial gurus had all the information in front of them. And that's why they were financial gurus. But right now, all the data is literally on the internet. And the data is what sways the Federal Reserve and other governing bodies that make financial planning and financial policy within the United States that ultimately trickles down to you, the end user. Whether you're buying stocks, cryptocurrency, your mortgage, your car loans, your credit card bills, your student loans, so on, etc., and etc. Today, there was a report called the Jolts report. The Jolts report stands for J-O-L-T, Job Openings and Labor Turnover. At the end of the day, it's just telling you how many jobs there are in the market. Today, we came out with a number of 11.2, nearly 1 million more job openings than was originally predicted. And last month, that number was actually 11 million. So we actually gained 2% in job openings. Now, in theory, you would say, hey, job openings is a great thing, isn't it, Adam? And yes, it's good for the economy. That means the economy is strong, but it's very bad for your bottom line, and it's very bad for the stock, crypto, and real estate market. Why? This, in addition to the unemployment report, which we're gonna get on this Friday, and I'm gonna be filming this live. The unemployment report is gonna be live on this channel, 7 a.m. Eastern, this Friday. Come check me out, all 3 of my channels. Why does the unemployment report matter so much in coordination with the Jolts report? If you ever heard Jerome Powell speak, he keeps saying that there's a discrepancy between job openings and job seekers, AKA job openings, positions available, and the unemployed or the employed. He keeps quoting this number of 1.9. It's a very, very simple number to figure out. You have job openings and you divide the job openings by the unemployment report, how many people are unemployed. And that's the ratio that you get. Up until about a month ago, that ratio was 1.9. He said it many times when he was doing his news briefings that right now we have a disparity of 1.9 job openings to job seekers. And then it went down to 1.8 just a month ago. The reports that came out today, the Jolts report, if you take the 11.2 million and you divide 11.2 million job openings by the unemployment report, not this current one, but the most recent one that we have until this Friday, you have unemployment of 5.7. 11.2 million divided by 5.7 million gives you a number of 1.97. 1.97 is greater than 1.9 and greater to the number that we can reduce to of 1.8. What does this mean? That means Jerome Powell has all the ammunition, all the data, all the backing that he needs to be as hawkish as he needs to be leading up into this next FOMC meeting. The unemployment report is coming out this Friday. We need the unemployment report to actually go up. What does that mean? That means people need to be out of work. More people need to be looking for work because there's a disproportion between job openings and the people looking for those jobs. As the job openings is here and the people looking for the jobs is here, we need it to go here. And the only way to do that is to reduce the job openings or to increase the people looking for that work. And the only way to increase these people looking for that work is to increase unemployment. Subsequently, unemployment is what also decreases inflation. Why? Inflation has 2 roads. Number 1 is the supply and number 2 is the demand. Since we can't affect supply other than buy us some time, and this decreases bottlenecks and opens up traffic jams of supply delivery. So right now we can only affect demand. Affecting demand can come in many different various shapes and sizes. One affecting demand is increasing the interest rate, which is what Jerome Powell is doing. As you increase interest rates, money is harder to come by, AKA more expensive. And as money is more expensive, you get less of it. And since you have less of it, for cheap, you spend less of it, which means that the demand in the market is going to go down. The second way to decrease demand, and the best possible way to decrease demand, is actually to increase unemployment. Why? If you are unemployed and you are on unemployment, your salary is drastically reduced, and it's reduced to about half a year. After that, you need to find yourself a job. So if you know you only have half a year of financing through unemployment, that means you will be spending a lot less money than you normally would. Absolutely decreasing the demand in the economy. Decreasing the demand in the economy by increasing the unemployment and increasing the interest rates will definitely severely attack inflation from this side and from that side, doing it a two-pronged attack. Now I want to go over something called the Consumer Sentiment Index. The Consumer Sentiment Index came out over the weekend. The Consumer Sentiment Index is just asking random people, this is not like government, random people, how they feel about the economy. How they feel about the economy today, how they feel about the economy in the short term, and how do they feel about the economy in the long term. This is what dictates the actual sentiment in the economy. This dictates the sentiment of people that are actually living within the United States. And it could tell us a lot about what's happening and if we're doing things right. As the sentiment is going up, that means the Federal Reserve is going to say, hey, strong jobs market, sentiment is actually going up. That means whatever we're doing is working. Inflation is probably going down as well. We got to see the next CPI reports. We need to see the next PPI reports. We need to see the next core reports. Well, then we can keep being aggressive. And as long as the Federal Reserve is aggressive, the interest rates are going to go up and earnings are going to go down when it comes to our beloved companies that we're investing in, and cryptocurrency is going to act just like the NASDAQ, because now it is a subsector of the tech sector of the NASDAQ. No more, no less. On this channel, I showed you the preliminary consumer sentiment report. That came out around 2 weeks ago. I filmed that when I was in Florida. Now comes out the actual real report. The next preliminary report is then going to come out on September 16th, which is right after the PPI report and a day after the CPI report. So you have the CPI report, the Consumer Price Index, you have the PPI, which is the Producer's Price Index, and then you have the Consumer Sentiment Preliminary Report. And this can give us a lot of data and try to give us a premonition of what's going to happen in the future, try to predict what's happening in the future so that we can invest a little bit better. The Index of Consumer Sentiment for August was 58.2, which means that it actually increased in July, is 13% up. Year over year, we're actually still down negative 17%. The current economic condition is at 58.6. In July, it was 58.1. We're actually up 0.9. This number was actually down when I spoke about the preliminary numbers 2 weeks ago. So it's very important that the current economic conditions actually increase the sentiment. So people are like, okay, currently the economy is not doing so bad. It's actually getting better. This doesn't seem like a big deal, but this is a huge deal. And the index of consumer expectations is actually up 58 from 47.3. We're up 22%. Survey of Consumer Director. The final August reading continued the early month improvement in consumer sentiment, rising 13% above July, but remaining 17% below a year ago. Most of the increases were concentrated in expectations, with a 59% surge in a year-ahead outlook for the economy following 2 months at its lowest reading since the Great Recession. So 59% are saying, hey, we believe that in the next year, things are going to get a lot better. That's huge. That means that the consumers are saying, hey, we see what's happening. We see you. We see what you're doing. We see what you're trying to do. And we believe that this is going to fix our economy in the next year. In addition, personal finance expectations rose 12% since July. Since the last month, personal finance also went up. This is huge, huge numbers, guys. And the final data point is the actual inflation. What the consumers, this is regular people like me and you, right? You always ask your friends, how you feeling in the economy? What do you think is happening? Well, this is actually a survey of people and what they think. The relative relief felt by consumer reflected in their inflation expectations. The median expected year-ahead inflation rate was 4.8%. It's very important that we see that 4.8%, and that's down from 5.2% last month. Do you remember what I said? That in 2013, we're going to get inflation down to 5%. This is my personal prediction. My personal prediction came before any consumer sentiment reports, and it's just based on my own data above and beyond the data that comes out in all of these reports, because I pool all this data together. So it's very, very interesting to see that the consumer sentiment of regular people is coinciding with my data, which actually vindicates my thesis and thought process and gives me more balls, so to speak, to invest the way that I want to try to predict the market and saying, hey, Adam, you're doing a good job, and what you're saying kind of makes sense. Not saying I'm right, I'm not saying I'm wrong, but it's very good to double check your numbers. It's very good to double check your thesis and your hypothesis when it comes to investing. Finally, it says uncertainty over expectations rose considerably, particularly among lower educated consumers. Long-run expectations came in the form of 2.9%, remaining within the 2.9% to 3.1% range seen in the past year. So next year, they're saying that it's going to be 5%. And the year after that, they're saying that the inflation is going to be between 2.9% and 3.1%, which is actually in line to what I predict and what I see is going to happen as well. Everything can change lickety-split. All of this has to do with what's going to happen on the unemployment report on Friday, what's going to happen in 2 weeks with the CPI report, with the PPI report, with the PCE report, and the next consumer sentiment report, followed by the FOMC meeting. All of these things matters, and all things can change really, really fast. The best thing you can possibly do as an investor is to follow this type of data. And although these videos do really, really bad because I don't have an audience that digests this type of information, all they usually want is a rah-rah, sis, boom, bah, what the hell is going to the moon? Like a lot of YouTubers, and they're just gonna flap their gums to you and lie to you about what's going to the moon because that's easy clicks and easy video content. It's a little harder to make these actual real videos that mean something and give you some type of substance. But with that said, I'm still gonna make these type of videos because I truly do believe the people that are gonna understand the data, the people that are gonna dissect the knowledge that's in front of them, dissect the information that's in front of them, I believe that those people are gonna be the best off when it comes to 2023, 24, 25, so on and so forth in the next bull run. Because as I always said, you don't make the most money during a bull run. You make the most money preparing in a bear run for the bull run that's gonna happen. And the only way to prepare for a bull run is to analyze all of this data. And the investor that's not analyzing this data is completely lost. That's why I never understood technical analysis charts when it comes to cryptocurrency, because you're missing the whole macro situation that's happening in the economy. Anyhow, thank you so much. Everybody have a great day. I'll see you Friday when I'm gonna be doing the unemployment report live on all 3 channels. The Berg is out.